welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. Looking ahead to the week beginning the 16th of March. Yes, that's right, almost halfway through, over halfway through March, we will be by then. Anyway, just before we start, I will ask you to have a quick read through the risk warning, as always. And whilst you do this, I will just pop myself on mute. So okay, so without further ado, let's have a quick look at what was been going on last week, and we look ahead to the coming week. Obviously, oil. This is the oil chart. Oil has been the big driver of most of the moves that we've seen in other areas of the market, and we've obviously seen these big moves in oil because of the conflict in the Middle East, and more particularly the closure or the effective closure of the Strait of Hormuz, which is that key shipping route for oil, fertilizer, and other goods. So oil prices, I mean, you know, spiked up to $120 a barrel at the start of the week. Has actually, this is a weekly chart that we're looking at, by the way, has actually it then eased lower, significantly lower, so back to around $76, $77 a barrel. So here we can see then it dropped down here to $77 a barrel before it's rebounded higher, and we're looking at around the $100 the barrel at the time of speaking, so recording. So I mean, obviously oil prices are the key gauge that we'll be watching as far as the Middle East conflict is concerned. The high oil prices add inflationary worries globally. And so we've also seen treasury yields, bond yields, gilt yields rise across the board. Yields are rising on concerns over the inflationary impact. And obviously this coming week, we've got plenty of central banks to be hearing from. I think there are 7 major central banks meeting next week. So clearly the market's going to be very interested in what the central banks are saying as far as the outlook is concerned. But it's also worth keeping in mind that no one has a crystal ball. So unless you're Donald Trump, then we have no idea of knowing how long this war is going to go on for, whether it's going to go on for just a few more days, whether it's going to be a few weeks, few months, etc., etc. And that's what's key as to how long it will go on for, as to what the impact on the oil price will be, or more importantly, how long the Strait of Hormuz remains effectively closed, and that's the impact on oil prices. So oil at $100 a barrel, Tehran so we're threatening oil's $200 a barrel. At the same time, we've had the IEA announce the release of 400 million barrels of reserves. We've also had Russia, the US has waived Russian sanctions for 30 days of oil to get the oil price down and to see more supply coming to market. So, but equally, the fact that oil's at $100 a barrel says that it is still concerned. Headlines will continue to drive that oil price, so it's going to be, you know, volatile to trade. I mean, if we just have a look here on this chart, we can see how huge that range is that we traded this week. We're above the 200 SMA, broken out of this rising trend line, falling trend line, dating back to 2022, and so, you know, the chart is bullish basically, but we're very, very overbought, which is something worth keeping in mind as well. Could be some consolidation, but as I said, this is going to be very much headline driven. Any sense of de-escalation could see the price fall back towards the $80 a barrel level, and on the downside, key level there at $75. Now, what's interesting is, I mean, if we just have a look at the S&P 500, for example, is the resilience that we've seen in the market. I mean, well, that's the weekly chart, but you know, maybe that proves the picture quite well. The resilience is unbelievable because that's just a little blip lower, which considering, you know, the spikes that we've seen in oil prices is really quite interesting. Still above the 200 SMA. Yeah, we've seen it come down a bit. It's taken out a couple of key supports, and momentum is definitely fading, but it's as if, you know, investors are sort of really expecting potentially a taco trade to take place here. That's where Trump always chickens out, and we could see the then prices quickly sort of rebound higher again. But I mean, just as far as support is concerned on the S&P 500, 66.25, that's the 200 SMA. We've been above the 200 SMA since June last year, so that would be relatively significant if we see a breakdown there. But this is the level, 6,500. This is the level that was touched back in November and also then in October. If we get a break below there, then we could see a deeper sell-off. So really, really interesting, the resilience that we've seen. So, you know, this is broadly within range. It's not really, we've not seen anything. The S&P 500, I think it's on track to close this week down around 0.5%. So, you know, that just highlights the level of resilience that we're seeing. But I think it's just interesting if we just have a look, for example, at the DAX. Clearly it is a slightly different picture. You know, we've seen a bit more of a sharper move. Obviously the Europe is more reliant on imported energy and oil, so that does mean that it's more vulnerable, and we're below the 200 SMA and below that multi-year rising trend line as well. So the picture does look a little bit more bearish as far as European markets are concerned. But let's and the other thing to talk about here is the US dollar. US dollar has been the safe haven of choice. You know, here we go, breaking out to a level last seen back in November. If we get above here, then you know, we could be looking to rise up around to around the 101.70 level. That's sort of the highs that we saw back in May last year. So this is the US dollar being supported. I mean, a couple of things to bear in mind here. Not only is this the safe haven of choice, gold, for example, is falling this week for a second straight week, but it's also the US is a net exporter of oil, which obviously benefits it as well. That's not to say that there won't be a stagflationary impact from the rising oil prices. Apparently petrol pumps in the US are already seeing around a 20% price increase over the past 2 weeks. But yeah, so definitely worth keeping an eye on the US dollar if it does break above this level here. So we're just testing it around the 100.50. It's just around here. That's going to be pretty key to create a higher high. So I mean, just sort of looking ahead to next week, you know, headlines surrounding the Middle East conflict will continue to, you know, drive the market. Oil prices will expected to remain the key gauge after, you know, heightened volatility this week. But oil as well, you know, it's actually up 3% this week. I mean, it was up 35% last week, but obviously, you know, that's still a little bit less than what we had seen last week, quite considerably less than what we saw the previous week. But as I mentioned, you know, the longer that strait is effectively closed, potentially the higher oil prices can go. Now we've also got the FOMC, so we've got loads of central bank rate decisions this week. This is the economic calendar here. You know, just have a look. We've got, so kicking off with some inflation from Canada. You've got the RBA, you've got the BOC, you've got the FOMC, you've got the BoJ, you've got Bank of England, you've got ECB. So, you know, lots and lots of central bank action as well as headlines to be watching. But the Federal Reserve interest rate decision is on the Wednesday. It's a 2-day meeting with the announcement on Wednesday. And expectations are for the Fed to leave interest rates unchanged at 3.5 to 3.75%. Now, the market's going to be more interested in the outlook, because obviously it's pretty much 99% priced in that they're not going to be moving. It's very much more the interest in what the Fed could signal through updated projections on the dot plot, stagflation risks, updated projections, and also the dot plot. I mean, if we think about how the situation has changed, stagflationary risks have risen quite considerably since the January FOMC meeting. You've got higher inflation combined with a weaker job market. Don't forget that we saw that 92,000 jobs were lost from the US in February, sorry. So obviously, sticky inflation combined with the weak jobs market does create tensions for that dual mandate for the Fed. Now, the conflict in Iran is adding to this sort of highly uncertain outlook, with oil prices, you know, as we've talked about, gyrating, and the market trying to price in what those risks are. So I mean, the Fed, like I said, is likely to leave interest rates unchanged and highlight sort of additional uncertainty in the outlook because of the Iran conflict. So, I mean, projections could sort of shift in a stagflationary direction. I mean, the market is no longer pricing in a June rate cut. And with another not really expected until the latter part of the year. So a hawkish sounding FOMC could actually help lift the US dollar higher. So watch for this level here to be breached. And I mean, what this means as well for stocks. Let's just bring up the Nasdaq. This is the Nasdaq again, finding support on that above the 200 SMA. It's down obviously from its record highs, but not massively given what's been going on. So you know, if we do have a hawkish sounding FOMC, then we might find that the Nasdaq comes under a bit of pressure, testing that 200 SMA there at the 24,400 level. Below there, you've got 23,970 comes into focus, which is also the low that we saw at the start of the week. Right, so what else? We've got Bank of England. So this is Thursday. Thursday, we've got Bank of England. We've got ECB. We've got Bank of Japan. Okay, so I'm just going to push through these relatively quickly. No central bank, as I mentioned, is expected to move on interest rates. So the Bank of England were going to be, well, widely expected to cut interest rates in the March meeting. But just a few weeks ago but the market's no longer pricing in a move this month since the start of the Middle East crisis, basically, and the surge of oil prices means that the central bank will almost certainly leave interest rates unchanged at 3.75%. Now, obviously, we've got sort of concerns. Now, the central bank, the Bank of England, had been expecting UK inflation to return to that 2% target by around April this year. That's probably not going to be the case anymore, and sort of a 3% year-end target is now looking a little bit more likely, according to the OBR. Also worth noting that there are concerns over the growth outlook. So we had GDP data today, which was weaker than expected at 0%. We've also got some concerns over the labour market, which is showing signs of weakness. And so that's also, you know, not good news for sterling, particularly against the US dollar. We've got the jobs market, which is also seen to be weakening. So again, this sort of could mean that the Bank of England's in a bit of a difficult position, where it's going to be seeing sort of sticky inflation and stagnant and weak growth, making it sort of challenging to be cutting interest rates because of that sticky inflation. I mean, the market, as I said, no longer expects that March rate cut, but could still cut a bit later in the year, although the timing is still quite unclear. and then there are even some who believe that the Bank of England could be hiking interest rates before the end of the year if we see persistent strength in oil and gas prices. This is GBP USD. It's trading in a downward channel. We've failed at the 200 SMA, failed at the upper band of the rising channel. The price has rebounded lower, looking towards that 131.20 level. So this is the level that we've seen a couple of times over the past year or so, but we've got quite a strong aggressive selling position or bias, should I say, given that bearish engulfing candle. So levels to be watching out for. This is just the next one, 132. That's the horizontal support, and then you've also got sort of 131.50, which is the lower band of that falling channel ahead of 130, the low that we saw back in November. So what else have we got? Oops, what happened there? Euro US dollar. This is the Euro US dollar, and we're seeing, quite a free fall here on Euro US dollar, given that what's been going on, as I've mentioned, the euro area, Europe is more reliant on imported energy, which makes it more vulnerable to volatile prices. So the ECB is not expected to cut interest rates either. Expectations had been for the ECB to leave interest rates unchanged across the rest of this year, and the market now will be looking for clues over whether sort of rising inflationary pressures from the higher oil prices will have an impact on the outlook for policy. Christine Lagarde, the ECB president's press conference, may give some indications there. But broadly speaking, I'd say ECB speakers have suggested that the central bank, would be ready to move if necessary, although they're also cautious not to act too quickly. Now, as we can see, this is the chart. Stagflationary concerns, slower growth, sticky inflation, broken out of this rising channel that it's been in, broken below the 200 SMA, dropping to current levels of 1440. This is the level on the downside to be watching. This is the 113.90, so just around the 114 level. If we get a break below there, that's the level we saw July last year. Could actually be then looking at much deeper level, deeper sell-off towards the 110.70 level. So still some way away from that for now. On the upside, the key level will be 115.65. A rise above there could see the euro on a more stable footing. And we did look at the DAX as well, didn't we? But this, just finally, let's have a quick look at the USD Japanese yen. Got the Bank of Japan rate decision as well. Bank of Japan is not expected to move on rates, but it could announce another rate hike in April. Now, inflation is proving to be a little bit sticky, but rising inflationary pressures from higher oil prices will be a particular concern for the industrial heavy economy, which imports, similar to Europe, most of its crude oil from the Gulf. Now, basically, this means that the currency also faces pressure from Japanese Prime Minister Sanae Takaichi to leave rates unchanged, but the Bank of Japan isn't necessarily having too much of it. So we'll have to see. Prime Minister Takechi will also be in Washington to meet President Trump on her first official state visit. I think it's also worth noting, if we have a look where we are, we're approaching that 160 level, which is the key level where FX authorities have warned that they could sort of, step in. We've had already suggestions and hints from Japanese foreign exchange authorities that they may step in to support the yen. Let's not forget, we had that stepping in, I think it was here, wasn't it, where we had that rate check by the US as well. But we've seen this sort of recovery from this low here of the sort of 152.60, rising to sort of levels last seen back in January. So be watching to see whether the price breaks above that 160 level. That's going to be key, not only in terms of potential increase of calls for intervention, but also for a technical breakout towards 160. And then you've got 162 up there. That was the level that was last seen in July 2024. So that's something, again, to be watching out for. Just as far as the downside is concerned, you've got support there around the 157.70 level and then the 156 level. So just finally, just a quick chat about NVIDIA. So you've got the NVIDIA it's sort of the GTC 2026 event, and that's basically, it's considered sort of like the Super Bowl of AI, if you like. It's a multi-day conference and the premier event for NVIDIA. CEO Jensen Huang is expected to speak, and AI investments now sort of new generation of agonic AI and also robotics. So basically, I think, this event may provide a bit of a friendly distraction from the markets away from the Middle East conflict, which will no doubt be a key driver. Again, we're going to expect to see showcases and, computer stacks and systems all surrounding the AI. So it does bring that focus back to AI, which we have been moving away from for some time. This is the chart, remains above the 200 SMA, above this ongoing support system that we see at 178.20. Just as far as levels to be watching on the upside, buyers are going to want to get above, for example, 193.76 in order to build a higher high and to bring 212 and fresh record highs into focus. So I hope you liked what I've said. If you do, I will look forward to seeing you again next week.